What if I told you there is a stock sitting right on your radar that has already exploded by over 738% in just the last 12 months, completely torched its old business model, rebuilt itself from scratch inside one of the hottest sectors on the entire planet, and is staring down a mechanical, multi-million-dollar forced buying event happening this very Friday? Not next month. Not after the next earnings call. This Friday. Welcome back to Smart Stock Sam, the channel where we cut through the noise, do the real homework, and break down exactly what is moving markets before it actually moves. I am Sam, and today we are going absolutely all in on Keel Infrastructure Corporation, trading under the ticker symbol KEEL. Now, before we go any further, here is the exact roadmap for today's video, so you know exactly what you are getting into. We are going to cover the explosive price action that has retail traders everywhere buzzing, the radical corporate transformation that triggered it all, the Russell 3000 index rebalancing happening on June 26th, and exactly why it creates a mechanical buying event most everyday retail investors never get to see coming. And then we are going to pull back the curtain on the options market and reveal one specific hidden metric that completely rewrites the short squeeze narrative that is absolutely dominating every financial forum right now. By the time this video is done, you are going to have a clear, structured, actionable game plan covering both the short-term traders looking at this week's setup and the long-term investors asking whether this story has real legs. Stay all the way to the end because the single most important number in this entire story is the one I am deliberately saving for last. All right, let us get into it. Let us open with the performance, because the raw numbers are genuinely stunning and they set the stage for everything else. 738% in 12 months. Think about what that actually means in real dollars. If you had put just $10,000 into this ticker a year ago, you would be sitting on over $83,000 today. Life-changing money. Right now, after hours, shares are trading around $6.32. But to truly understand why this stock has done what it has done, and far more importantly, where it could be headed over the next few days and beyond, you need to go back to the beginning and understand who Keel actually is. Because this company was something else entirely just a few months ago, and that transformation is the entire engine behind everything we are discussing today. If you follow cryptocurrency, you might remember a company called Bitfarms, a well-known pure-play Bitcoin mining operation. In April of 2026, Bitfarms officially rebranded to Keel Infrastructure Corporation. But this was not just a cosmetic name change. This was a complete strategic reinvention from the ground up. Management looked hard at the landscape, saw what artificial intelligence was doing to global power demand, and made a bold pivot away from Bitcoin mining toward high-performance computing infrastructure and AI data centers. Now, here is why that matters so much right now. Artificial intelligence is not just clever software running on ordinary computers. Every time a large language model processes a query, every time a neural network trains on a new dataset, every time a hyperscale cloud provider spins up another cluster of graphics processing units, it consumes an almost incomprehensible amount of electricity. Power demands are growing so explosively they are already outpacing national power grids. The companies building AI infrastructure are not just hunting for land and fiber, they are desperately hunting for raw, reliable, large-scale electricity. And this is exactly where Keel becomes compelling. They are sitting on a 2.2 gigawatt power pipeline across Pennsylvania, Washington State, and Quebec, Canada. In the AI gold rush of this generation, Keel is not selling the pickaxes. They are selling the electricity that powers the machines doing the digging. That single insight is the foundation of the entire bull thesis. But here's the question you should always be asking on this channel. Does a company in the middle of building out this kind of massive infrastructure actually generate any meaningful revenue yet? Let us look at the numbers with complete honesty, because Smart Stock Sam will always level with you even when the truth is uncomfortable. Keel's financials for the first quarter of 2026 are, to put it plainly, rough. Revenue came in at $37 million, which actually represents a 23% decline compared to the same period last year. Their net loss landed somewhere between $127.6 million and $145.3 million for the quarter. Free cash flow is deeply negative, bleeding approximately $75 million in a single quarter, driven almost entirely by the enormous capital expenditures required to build out these AI data centers from scratch. Now, before you close this tab and move on, hear me out, because context is absolutely everything here. Companies in an active infrastructure construction phase do not show profits. They pour concrete, they pull permits, they string fiber, and they burn cash while they build the asset base that will generate returns later. What they need is not profit yet. What they need is runway, and Keel has it. Thanks to recent financing, they are sitting on approximately $357 million in cash liquidity, alongside roughly $573 million in long-term debt. They built that runway through a $458 million convertible senior note offering at a remarkably low interest rate of 1.25% due in 2032. The market actually absorbed that offering surprisingly well, and the reason is important. This cash injection fully funds their data center developments through the critical leasing phase without immediately diluting current shareholders through new stock issuance. But here is the specific number from that offering. I need you to lock into your memory right now, because I am going to come back to it and explain exactly why it matters when we talk about the trade setup. The initial conversion price on those convertible notes is $7.41. They also structured capped calls that limit maximum dilution all the way up to $11.86. Write down $7.41, underline it, circle it, because that number is going to be the difference between a clean, profitable trade and a frustrating one. Trading today at a 4x price-to-sales multiple, the market is clearly pricing in success that has not happened yet. You are paying for a story. And that story has one defining plot point that everything hinges on. I call it the one lease away scenario. The entire current market capitalization of Keel Infrastructure rests almost entirely on the market's expectation that they are going to land a formal, signed, hyperscale AI tenant lease from a major cloud provider or AI company. Just one signed lease changes everything overnight. It converts the terrifying quarterly cash burn into predictable, long-term contracted cash flow. It validates the entire AI pivot strategy in the eyes of the market. It opens the door for the massive wave of institutional investment that has not arrived yet. But here is the razor's edge this company is walking. That lease has not been announced. They have a pipeline. They have permits moving through approval. They have power capacity ready to deploy. But no ink is on paper yet. Could construction delays push their facilities past the peak AI infrastructure demand window? Could a well-capitalized competitor lock up the most attractive hyperscale tenants before Keel gets there? What happens to the stock if the first lease announcement comes in significantly smaller than the market has priced in? These are the questions worth sitting with seriously, and they are exactly the vulnerabilities that the large, well-funded short sellers in this stock are relying on. Which leads us directly into the short squeeze narrative, because if you have spent any time on Reddit or any financial forum this week, you have seen people absolutely screaming about an imminent short squeeze, and they are telling you half the story. Yes, short interest in Keel is genuinely massive. 29.79% of the public float is currently sold short. That is over 73 million shares betting directly against this company. On the surface, combine that with a hot AI story, a major index catalyst on Friday, and obvious retail momentum, and you can see why people are calling for the shorts to get absolutely crushed. But here is the critical metric that everyone screaming squeeze is conveniently leaving out. The borrow fee rate on Keel right now is sitting at approximately 0.35%. That is virtually zero. Let me explain why that completely changes the squeeze equation. The borrow fee is what short sellers pay every single day to maintain their short position. When a stock becomes genuinely hard to borrow and that fee skyrockets into double-digit percentages, it creates real, painful, daily financial bleeding that eventually forces short sellers to cover and buy back shares. That buying back is what creates the mechanical explosion of a true short squeeze. But at 0.35% annually, short sellers can hold their positions for years at essentially no cost. There is no clock ticking. There is no financial pain accumulating. The shorts are not scared, they are not bleeding, and they are not running. High short interest with a near zero borrow fee means the squeeze narrative is missing its engine. Do not build your entry in this stock around a squeeze that has no mechanical trigger forcing it to happen. The real mechanical catalyst you should be focused on entirely is happening this Friday, June 26th. That is the official reconstitution date for the Russell 3000 index, and Keel Infrastructure is being officially added to it. Here is what that means in purely mechanical, real-world terms. Hundreds of exchange-traded funds and passive mutual funds exist with a single mandate: mirror the Russell 3000 exactly, not outperform it, not make judgment calls, just match it precisely. So when a stock is officially added to that index, every single fund that tracks it is legally and structurally required to purchase that stock. They do not analyze the chart. They do not debate the business pivot. Their mandate says own it, so they buy it. This creates a concentrated wave of forced, non-discretionary purchasing that hits almost entirely in the final 30 minutes of the trading session on Friday, June 26th. And the entire professional trading community has known this event was coming for days. Institutional algorithms, sophisticated proprietary trading desks, and informed retail investors have all been positioning themselves ahead of that guaranteed demand. Front-running an index rebalance is one of the oldest and most reliable mechanical games on Wall Street. Elevated volume, compressed spreads, and potential sharp intraday momentum are all highly probable as we approach that Friday close. Wall Street analysts are watching all of this unfold with a divided view that itself tells you something important. The consensus sits at a moderate buy rating, with an average price target somewhere between $5.90 and $6.22, which interestingly sits slightly below where the stock is trading right now. But the dispersion between individual analyst targets is enormous and revealing. On the conservative end, Cantor Fitzgerald maintains an overweight rating but sets their price target at just $3, implying more than 50% downside from current levels. On the bullish end, Citizens JMP initiated fresh coverage with a market outperform rating and a price target of $10, citing compelling economics behind repurposing industrial power assets for high-performance computing. Alliance Global sits at $8. HC. Wainwright raised their target to $5.50 based on imminent permit approvals. A spread from $3 to $10 on a stock at 632 tells you exactly one thing. The smartest analysts with access to the same data cannot agree on what this company is fundamentally worth. That disagreement is the volatility. That disagreement is the opportunity and the danger simultaneously. Institutional ownership data makes that picture even more striking. As of the latest available filings, only approximately 19,225 shares are held across just two institutional positions, those being Nilsen Partners and Jane Street Group. That is essentially nothing for a company at this market capitalization level. The public float is dominated almost entirely by retail investors and algorithmic day trading strategies. There has also been no reported insider buying or selling since the AI pivot was announced. No executives are loading up their personal brokerage accounts. No board members are signaling conviction with their own capital. Without a stabilizing institutional base providing a natural demand floor, this stock has no cushion during sharp sell-offs. Violent beta swings in both directions are not just possible, they are built into the structure of this market. Plan accordingly. The technical picture heading into Friday reflects exactly that dynamic. After running to the 52-week high of $7.37 on June 22nd, the stock pulled back and closed at $6.12 on the 24th before recovering to around $6.32 after hours. Short-term moving averages are showing caution signals. The stock is trading below its 10-day moving average of $6.24 and its 20-day moving average of $6.52. Both of those are mechanical, near-term sell signals. However, the broader structural uptrend remains intact. The stock is comfortably above the 5-day average of $6.01 and the critical 200-day average of $5.45. Momentum oscillators confirm a cooling off phase, not a breakdown. The relative strength index sits at a neutral 44.09. The moving average convergence divergence is slightly negative at negative 0.069. This is a stock catching its breath inside a larger uptrend, and breath-catching moments inside uptrends have historically created clean entry windows for prepared traders. Here is your actionable pre-Russell rebalance swing setup for June 25th and 26th. For the entry zone, focus on the $6.15 to $6.25 range, scaling in on dips toward that level. Immediate support is the $6 put wall, where over 2,000 options contracts are concentrated. Your hard stop loss, non-negotiable, is $5.80. This is a major structural trend line and a key Fibonacci pivot support. If this level breaks, the setup has failed, and you exit without hesitation or debate. On the upside, target 1 is $6.50, where both the options open interest concentration and the 20-day moving average resistance converge. Target 2 is the $7 to $7.15 zone, directly into that massive call wall of over 7,000 contracts sitting at $7 ahead of the Friday close. And now, that number I told you to memorize. The convertible note conversion price of $7.41 creates a nearly invisible ceiling. The sophisticated arbitrage funds that purchase those convertible notes have a direct financial incentive to short the stock at exactly that level to lock in their conversion premium. Expect heavy professional selling at $7.41. Do not expect this stock to break through $7.41 with any ease this week. Plan your exits before that level. For long-term investors, the path is actually far simpler. Treat Keel exactly as what it is, a high-beta, highly speculative infrastructure play priced entirely on future expectations. The single metric that matters above everything else is a formal, signed hyperscale tenant lease. Until that announcement is made, you are trading pure momentum and pipeline promises. The moment that ink hits paper with a legitimate hyperscale partner, the entire narrative transforms. Cash burn becomes justified. Institutions arrive. The valuation multiple expands significantly. That lease announcement is the real starting gun. Until then, size positions to what you can afford to lose entirely, and resist the temptation to let short-term price action create conviction you have not yet earned. Before we close out, I have to be very clear with you, and I want this on record. Nothing in this video is financial advice. Everything you have just heard is for educational and informational purposes only. I am not your financial advisor, broker, or a licensed investment professional. Stocks and options involve extreme risk and are not suitable for all investors. You can lose every dollar you invest. Past performance of any security never guarantees future results. Please always conduct your own independent research and consult a qualified licensed financial professional before making any investment decisions. Data presented in this video reflects information available at time of recording and may have changed. Smart Stock Sam is not responsible for any financial decisions made based on content published here. All right, that is the full deep dive on Keel Infrastructure. Now I want to hear from you. Keel has raised $458 million, controls 2.2 gigawatts of power capacity sitting at the center of the AI infrastructure boom, but has not yet signed a single hyperscale tenant lease. So here is my question for the comments section. Is Keel the next great AI infrastructure story of this decade, or is it simply the most expensive power plant that nobody has rented yet? Drop your honest take down below. I read every comment. If this breakdown gave you real clarity on a ticker you were already watching, or opened your eyes to something new before Friday, please hit that like button right now. It genuinely takes you 2 seconds and it helps this content reach more investors who need it before the market moves. If you are not subscribed yet, hit subscribe and ring the notification bell so you never miss another breakdown like this one. If this level of research adds real value to your investing journey, you can also support this channel directly through YouTube's Super Thanks feature right below this video. Every bit of support goes straight back into making this content deeper, sharper, and more frequent for this entire community. And finally, I recently launched the Smart Stocks SAM exclusive membership community, and I want you in there. Members get early access to watch lists, trade setups before they move, deeper analysis beyond what is on the public channel, and a community of serious, focused investors and traders all working to genuinely level up together. The link is in the description. Come join us. Because the best investing decisions you will ever make are the ones made with more knowledge, better context, and the right people in your corner. This is Smart Stocks SAM. Trade smart, protect your capital, and I will see you in the next one.